Hello there, everyone. Welcome to this week's chat between myself and Ralph Hebgen, of course, in the London studio. Ralph Hebgen, of course, who was a brilliant equity research analyst for over 20 years. He doesn't look a day over 31, I know, but he was a brilliant 11-year-old. Anyway, this week we are going to be talking about ESG, the Northern Ireland deal, and hydrogen-powered cars. So those are the three main things we're going to be covering. So strap in for a good time is maybe not a phrase that you would necessarily associate with commercial. Anyway, let's do that. So starting off with ESG, I think that it would be fair to say that this has been quite a key week, right? So ESG, it's been a hot topic of investment for many years now, and I think that it seems to be, especially since the Ukraine war, it has been ironically under fire because of the Ukraine war, and it has exposed its weaknesses essentially. And the reason why is because a lot of ESG funds have not been able to invest in controversial sectors like defence, like oil, like, say, pharmaceuticals, for instance. And so what then happened was we had the invasion last year. Suddenly, gas demand, oil demand, etc., all just, shot up. But the ESG funds were not really able to participate in the share prices going up, and therefore their performance was not very good, whereas the non-ESG funds performed pretty well. So those are, this is obviously a generalization, but anyway, the other thing though that is different about this week is that so Joe Biden is a Democrat. And the Democrats had these rules whereby this rule that they wanted to bring in to make investors do a kind of, I guess, a way of saying it is to put an ESG overlay onto their investment decisions. Now, the Republicans were against that. They want to be able to give the investment managers the freedom, and so there was a vote. Now, interestingly, Joe Biden's lot, the Democrats, lost. It was very narrow because some of his team went over to the opposition on this. So the idea is he is going to use his veto to overrule this, and they're going to go through with it anyway. So you've also then got the likes of BlackRock, KKR, various other investors who have been saying, listen, we want to be able to have the ability to buy other things as well, should we see fit. So there's a lot of things going on, a lot of pressure going on about this at the moment. What do you think about this, Ralph?
Well, yes, what it smacks of is an additional layer of regulation where none would have been needed. Because if you're saying these things which are happening in the US currently, where Joe Biden is basically instrumental in creating an ESG investment filter or overlay, and you have to invest in companies which to some extent endorse the tenets of ESG investing, then obviously it follows that you can't actually invest in everything you want. You can't invest in the entire spectrum of stocks which are listed in the market. Now, it's interesting to actually see that there is already now a backlash from the powerhouses in the investment management world. BlackRock, you mentioned, T. Rowe Price, I think, is part of it, KKK. And
KKK?
Sorry.
I I don't think they're investing, as far as I know.
I don't think they should be investing. I think that's was definitely not going to be ESG.
No.
And so, yes, apologies.
Yeah.
So the problem with ESG investing is, of course, that you have a criterion which is not in itself directly linked to return creation and earnings generation. And in the end, I think, and we've discussed it before, in the end, I think investors are going to want to see what they came to the fund manager for to buy, which is a return in their pension funds, in their investments. And if the return is not forthcoming, then no element or no amount of let's call it ideological investing is going to compensate for lack of return. Now, I think there is, to some extent, perhaps, and I think you offered this theory with which I agree on a previous podcast, there's to the extent self-fulfilling prophecy. If everybody funnels investments into ESG labeled companies, then it would follow that the price of these companies would go up. But then at times where other investments are favored by, let's face it, adversarial circumstances, like there is sadly and unfortunately a war going on, which is driving energy prices up, then if you're not invested in energy producing companies, then you're going to lose out of the returns offered by these companies. So in the end, I'm not saying ESG investing should be discouraged, because I actually believe it should be encouraged. It is not a bad thing to invest in sustainability, in environmental factors, in companies which have a suitable governance system, for example, which would resolve workplace conflicts, etc. Of course, this is a good thing, and I think that investment or directed investment into these companies would, of course, then also almost like socially engineer good corporate behavior. So that is all excellent. It should just not be that the pendulum swings the other way and you can no longer invest in the entire range of companies and stocks which are quoted. That is where I think the Biden administration may have gone too far, and the backlash which we're seeing is probably going to correct the pendulum swing so that it comes back to a more happy medium, which hopefully then will mean that fund managers can get the return from where the return is, where the earnings generation is, and also investments are directed towards companies which embrace these tenets, which are, of course, in themselves laudable and necessary.
Absolutely, yes. I think, yeah, I agree with all that. I mean, I think you're referring there to. I have this sort of pet theory, which may or may not be right, but I just, my impression is that you had, with regards to investing, you've got active investing where you've got a human making the decisions based on various different, things. And then you've got passive investment, which is, an algorithm investing, you're putting the money in one end of the machine and it's spitting out, shares at the other end. I mean, it's not quite like that, obviously, but, but anyway, you've got that. And over the years, the trend has been, for money to move away from active investing into passive investing. I mean, I know that, as a broker, I lost, a few people, a few clients who they were saying, look, I'm sorry, can't do any business anymore. I've been indexed, which means, they've gone off, their money has been taken away and it's been put into a fund which is run by an algorithm, essentially. So, so anyway, there's been a trend going from active fund management to passive fund management over the years. And my theory is that a lot of fund managers will have seen this and thought, how do I keep my job? And then seeing the whole, rise of ESG, and I know for a fact, some ex-clients, some of my ex-clients have actually, they've done exams, they've done, they've got qualifications in ESG, so that they can make that transition. So you then get this kind of move into of them into ESG. There are more jobs in ESG. There are more funds. So, like you were saying just then, what has happened is you've had this influx. The money has been coming in, but because you're only able to spend money on a narrower section of stocks and shares, it has perhaps inflated the value of those stocks and shares artificially, because the money has not been able to go elsewhere. And that is fine when you've got ESG is working and everyone loves it. But the problem is that when the wheels fall off, which is what happened last year, what then happens is that everyone says, well, I've put all this money in ESG and your performance is rubbish, and the performance of XYZ down the road, which doesn't have the restrictions, is a lot better. What are you going to do about it?
Yeah,
that's why, in a way, I kind of think that maybe the likes of the BlackRock and stuff are now turning around and saying, well, we need to be able to have the freedom to do what we want and all that kind of stuff. So I just think that that's how I feel. That's what it feels has happened over the years. But yeah, it's. I mean, the whole thing, it's always evolving anyway.
Yes, exactly.
The industry, depending on what's hot, what's not, and any kind of external circumstances.
Well, I think it's definitely here to stay, and it will develop in future. I mean, let's also not forget that this is not a new concept. Ethical investments have been around for more than 20 years.
Oh, yeah.
And this has widened its scope into ESG. But I'm not sure. I think ESG already exists in different hues, in different layers, in level 1, 2, 3, or something, and that's also not a bad development. I think the marketplace is going to just develop and allow people to invest in accordance with their worldview and philosophy. And it will very probably become less prescriptive in the way that fund managers are, of course, going to be allowed to invest in wherever they want. And if you have this ESG layers in different strength and intensities, level 1, level 2, level 3, etc., then I think that will actually perform a valuable service to society in the end, because of course it will promote and thereby foster what I said before, good corporate behavior, and that's of course positive.
Absolutely. So I think that's it is a constantly evolving area, and I'm thinking that if one wanted to take all of the hot themes together, maybe you could make a ChatGPT ESG fund. Okay, potentially.
What you could do, which I was thinking, I mean, I'm not going to talk about this, just as to amuse you guys. I mean, I don't know whether you guys remember CDOs from the financial crisis. That was a sort of instrument which put together crap and worse crap and called it excellent. I mean, that's basically the technical explanation of what went on. And you can do the same with ESG. You can put all the various layers into an ESG kind of product, and then maybe slip in some armaments and some tobacco as well, which is going to be ESG 0 rated, and then call it overall ESG something. I wouldn't be surprised if that sort of thing might actually happen as well.
Yes,
which
I'm
of
sure.
course be a cynical view to have, and I would never promote.
No, of course not. Of course not. Personal thoughts. So brilliant. Thank you very much indeed. I mean, it really is a great topic. So anyway, let's talk about the Northern Ireland, a deal that was announced this week.
Yes.
A rare moment of cordiality between Ursula and Rishi. So this was obviously momentous from a political point of view. This has been hanging over us for a number of years now. There's just been toing and froing over what's been going on with Northern Ireland. What's your take on it, Ralph?
Well, first of all, I agree. It was a rare moment of cordiality. It was also a rare moment of British statecraft after years and years of Mickey Mouse behavior. This is just my opinion, guys, but I'm just saying it. No, I think the Northern Ireland Protocol was a real issue hanging over the UK economy, the UK politics as yet to be defined as a post-Brexit economy country. And I think certainly this deal has the potential to ease this potential source of constant conflict and mean that we can actually move on with our lives in our respective countries. Now, let me just say, first point, economically, I do not think necessarily much is going to change for the UK as a whole. If you just look at the regions and just look at the GDP by region in the UK, Northern Ireland is about 50 billion. And it's actually the smallest region in terms of GDP. And if you look at the biggest region, that's London, which is 500 billion, you get a feel for the comparatives here. So London in itself is 10 times the size of Northern Ireland in terms of GDP. If you take the southeast and London, you have 800 billion, which is 40% of the UK GDP being produced here in the southeast, and 2.5% in in the northwest, if you like, which is Northern Ireland. So I think in terms of cold numbers, not much is going to change for the UK economy as a whole. But what is important here is, of course, that the relationship with the EU has now been stabilized and has been clarified. And what would surely have been a source of constant potential strife between the UK and the neighboring economic superpower, the EU, is unlikely to be an issue in future. And we know what the touch points were. Liz Truss and Boris Johnson basically threatened to break international law over this. And that's the severity which we might have seen. So that's positive. Also then by extension, it might now clear the way and open the door for further negotiations with Europe on the as yet outstanding issues. The most important one for the UK, of course, being any financial services accord or a further reaching accord on financial services. In my wildest dreams, by the way, you know that Joe Biden is averse to a US-UK trade deal, mostly because of the Northern Ireland question, because he thinks he's Irish, which he may be, I don't know. But this is.
By the way, I always thought that Barack could have been, couldn't he? Because his surname is Obama, isn't it? If you just put a apostrophe.
Oh, I see. Right. Oh, excellent. Yeah, I didn't see that. Yeah, cool.
Yeah, sorry about that.
Well, you know the Bertha debate, of course, this horrible, infamous debate, which was kicked off by Mr. Trump.
Oh, right.
Claimed that he was born in Kenya or something.
Right.
And then I think Trump went to Hawaii for a state visit, and he was greeted with lots of people wielding signs, "Welcome to Kenya," because.
Very nice.
Yeah, very nice. Excellent. So back from Hawaii to the.
Yeah. But I think that it's very interesting this, because I think that that there was initially a lot of store put in this in terms of what it might mean for the financial sector in the UK. Because so there was a memorandum of understanding that was signed a couple of years ago, and it sounds like the impasse on Northern Ireland was used as the excuse for why this didn't go forward any further. So now that the Northern Ireland deal has been done with the Windsor framework, sounds like a climbing, a children's climbing frame. But now that has been done, it looks like the next thing that should be done is maybe the memorandum of understanding. However, I kind of think that the Europeans, I think that London has. This is going to sound very patriotic. It's not. It's absolutely not. It's just how it is, as far as I can see. Is that London has been, the supreme sort of financial powerhouse in Europe for a very, very, very long time, and I think that Europe will see this as Brexit as a once in a lifetime opportunity to try to somehow wrest power away from London. Now, I don't think they've done a good job of it over the last few years. It hasn't really happened. All of those predictions that all these jobs are all going to go to the continent just hasn't really happened. And so it does make me wonder whether, they're going to try and find different ways of how to delay things, string it all out. But I don't know. I mean, what do you think, Ralph?
Yeah, I don't think the Europeans are necessarily going to want to do this, and they don't want to be conciliatory. But I don't want to be too provocative, but I think they just have to fess up, and eventually they have to be because they need London. You see, you say they haven't actually been very successful in doing this over the last 3 years since the referendum, but they haven't really been successful over the last 40 years. Because nothing really has changed in particular from the point of view of the God, I need to stumble over my words here. From the point of view of the Europeans, all that has changed is that they might actually have now more potential to develop their financial centers than they had before. Because of regulations, some of the jobs which were housed and domiciled in London have to go to Europe, mostly retail bank-orientated jobs. And that has happened. I mean, JP Morgan, Goldman Sachs, they have basically sent 3,000 employees each, I think, to Europe. But that's the sort of order of magnitude we're talking about. And so I think that the EU might well wish to delay and defer an accord here. But I think eventually they will have to give us something, because I don't think that the Europeans will have the capacity to rival London as a financial center. And there are various reasons for this. I mean, one is perhaps one needs to sort of remember that it's not just financial markets and financial products which are important here. It's the entire superstructure of, let's say, enabling companies, which has to be there, which has to be developed. It's governance, it's law firms, etc., with the specialization which is necessary. None of that exists to the same extent in Europe as it does in London. Second point is language. This is actually quite intangible, and people tend to forget this because everybody speaks English. I mean, this is true. If you go to Frankfurt or Paris, Milan, etc., people do speak English, but they sort of speak English. It's like school English. It's like they learned it at school, but they don't speak it idiomatically, and they speak it with an accent. Oh dear. Yeah. Hello. but But they don't speak it idiomatically, correctly, and B, they don't speak it like a finance person would. They don't speak it like a city person would, City of London, or a Wall Street person. And I think if you come over from New York or London and you do a deal in Frankfurt, of course they're capable of doing it, absolutely. But they don't, there's not the same sort of feeling of intimacy. It's not, they're not one of us. That's the sort of feeling which you have. And yes, I know it's intangible. It is not a driving component, but it is there. Second is mindset of people who live in these countries. Take it from me as a German national. The German soul is not as risk embracing as the English soul, so to speak. It is no surprise to me that the English society and the UK economy is the most free market competitive economy in Europe. All other economies are more regulated, and they are more regulated because the people who live there want that. It's a different worldview, a different philosophy. If you go to Germany, you have people who live in a welfare state. They want to be protected by the state, and they are. They see that as a benefit. We in the UK wouldn't see that as a benefit. We have a word for this. It's called the well, what is it called now? The some pejorative word which I forgot, which doesn't actually say anything to my eloquence.
You're amazing.
No,
God,
I'm not.
Ralph.
I'm lost for words here. What? It's because I don't have children. It's some nurse state or nursing state.
Nanny state.
Nanny state. There we are. Thank you very much, sir.
There
Beautiful.
we go.
And I can now drone on because now I found my words again. That's exactly right. So there's a pejorative word in English for this. We don't like too much regulation. We don't like intervention of the government. It is seen as a constraint of our freedom, of our liberty. In Germany, it isn't. In Germany, it's seen as a benefit, as protection. And that goes into the financial markets as well. Whenever I go to a school reunion in Germany, I have discussions with my ex-friends and from schoolmates, and they say things like, "Oh, I only will ever invest in really, really secure things. I don't invest in funds. I invest in bonds."
Yeah.
And this is all fine. There's no issue with this. But what I'm saying is that it is something as intangible as mindset which prevents Germans and also Italians and French people to invest in equity markets at the same scale as an English person would naturally do this. As a consequence, equity markets are not as deep and as liquid in most of the continental bourses countries. As a consequence of that, all the expertise which develops with a more competitive market doesn't live in these countries. People who have this expertise and who develop this expertise come to either London or they go to New York. And as a consequence of that, what you don't have is the sort of playful inventiveness with financial products. And I know this from my own experience. Before I came to the city proper, I was sort of doing something in commercial banking, and I was developing some products involving insurance. So I went to Frankfurt, and I was trying to do this there, and I just couldn't do it at all. I mean, what people said to me is, "Ralph, you can't do this. You can't do this, and you can't do that. And here's the reason why." And there's a long list of reasons why you couldn't do something. So I went back to London, and basically I could do it here because people here were interested in the product. They found ways around the regulation. This is called financial engineering. And so in the end, I think all these conferences, all this congeals into a situation where you have a lot of often intangible factors which lead to very real and very tangible elements in the financial markets, and these are that the equity markets in Europe are not as liquid, they're not as deep. As a consequence of that, you do not actually get easily IPOs away, and the corporate landscape is just much richer in terms of allowing companies to fund themselves from the equity markets in the UK and the US. So my final conclusion from this is I think that the Europeans don't really have a leg to stand on if they want to rival London. London cannot rest on its laurels. The competition is there, but it is in the US. It is not necessarily so much in Europe. If the Europeans wanted to dither and defer this in order to allow themselves to develop the same infrastructure, I think they need decades, not years.
Interesting.
To do that. And that is, I think, why eventually, not next year, not in 2 years' time, perhaps in 5, the Europeans will be quite happy to come to the table because they need London for the development of their own corporate landscape and come to some level of understanding.
Interesting. Yeah, it's fascinating. Fascinating.
I'm sorry.
Stuff.
I hope I wasn't on my soapbox here.
No. It was very good, and yeah, I think it's something that I don't know. I do think about from time to time, and I guess this this deal just kind of brought it up again really. But anyway, yeah. So thank you very much on that. All really, that's great. So let's final subjects now. Talking about hydrogen-powered cars.
Yes, I forgot that.
So this is really interesting that we heard this week that BMW are looking to launch. They're looking to launch hydrogen-powered cars. That makes it sound like they're going to shoot them out of a cannon or something, which they're not going to. But yes, very interesting because, of course, everyone and
it's
their
like
dog.
Power Rangers.
I know, that is really good, isn't it? Everyone and their dog is doing lithium-ion batteries now. Actually, interestingly, they're also looking at lithium-ion phosphate, the basically older, less efficient types as well. But the fact of the matter is that, it seems to me that everyone is put all their money, all their effort into lithium-ion, ION, not IRON, it's a bit ION, lithium-ion battery technology, which ultimately looks like it's going to fail because we don't have the resource. We don't have enough resources to continue to make the batteries that are, on a scale that our politicians require. So it seems to me that you've got companies like Hyundai and Toyota who are making inroads with their hydrogen powered vehicles, but BMW talked this week about it is also doing something with hydrogen as well. So I just thought, that was an interesting development. But again, what do you think, Ralph?
Yes, indeed. This is indeed a very interesting development. I was aware of the hydrogen link arm which BMW had for a long time, just because I was surprised to see it 10 years ago. And it appears now that BMW have made a strategic decision to put a lot of investments into the development of hydrogen-powered vehicles alongside EV, electric vehicles. Now, let's also just remind ourselves, BMW have made a major investment for electric vehicles in China recently. And that is sort of the context in which I want to put this. This is going to sound like a bigger framework than we need, but I just like to put this into a context of a new developing world order. And in the end, it is the free world against a consolidating autocratic world. We've talked about this before. I'm not going to repeat all this. That's not what we're talking about now, but we all know what we mean by this. And we mean China as the lead nation as the hegemonial force in Southeast Asia. India is dithering about. They don't really know where to fall yet, but it looks as if they could either fall for the free world or for the newly empowered Asian region, which is going to develop.
Mm.
We don't know. China doesn't know either, but surely they would want to have India on side rather than on the side of the free world. So
Mm.
I'm thinking that the free world needs to and does respond to this somehow. And we've seen a different development. It's got nothing to do with hydrogen at the moment. This is got to do with the Anti-Inflation Act in the US and Joe Biden's um, uh, policy to ease investments, to lure investments into the US by giving them incentives. And that, to me, is a carrot and stick strategy, because specifically he is saying that you can come here, invest make an investment here, build your factories here, but for chip makers specifically, but what you cannot then do is to go to China for 10 years. So
Mm-hmm.
carrot, you get incentives here, but you can't go to China. And that sort of policy, I think, is going to be seen a lot more often. And
Mm-hmm.
the way I would slot hydrogen into this is simply like this. Lithium is another raw material which is mined in China extensively. Anything which is necessary to build electric vehicles is going to make the free world again, to some extent at least, dependent on raw materials mined in the autocratic world. There
Mm-hmm.
is a real parallel to oil and gas and the current Russian-Ukrainian war.
Mm-hmm.
And so I think that businesses domiciled in the free world will do well to look for alternative industries, alternative technologies, and hydrogen is a technology alternative to electric vehicles, which I think we're going to see a lot more investments pumped into these type of alternative technologies. Alternative in a sense that they're alternative to an industry that is dependent, at least to some extent, on raw materials and manufacturing capacity in the consolidating autocratic state bloc,
Mm-hmm.
let's say. And so, sorry, this has gone a long way from BMW hydrogen, but I think this is a wider envelope in which we have to see this investment. I don't know whether BMW's strategy was deliberately informed by these views. I rather doubt it, but we will see a lot more of this type of dynamic, I think, developing as we are seeing this new, let's say, political dynamic play out in future.
I mean, another sort of thing to add to that is that, of course, the EU announced very recently about emissions and they're looking at no sale of new petrol-powered cars after 2035. So in this country, it's 2030. In the EU, they're proposing 2035. But it sounds like Germany, along with a few other countries, like I think France, Italy, Poland, are going to push back against that. So that's not, we don't know what's going to happen there. But anyway, I think it's quite interesting in the context, the wider context of everything else. But I mean, ultimately, I think that it is madness to continue with just one technology. We need to pursue different ones, especially it's almost like we know that it's not going to work, and yet we're still doing it. We keep hearing that there's not enough nickel, there's not enough cobalt. There's not enough lithium, not enough cobalt, not enough, or maybe there might be enough nickel, but those various other things, there's not enough, and we keep being told that, and yet even if we mined everything that we have out of the ground, which isn't going to be great for the environment. I hasten to add, we still won't have enough. So why? I mean, the only reason why I can think of why we are still pursuing this is because, this is a cynical point of view, but I feel that so many companies have poured many, many billions of dollars into the development to get where we are now. They're not really going to be super happy about looking at something else that might work. That, if it doesn't work that well, then they're spending even more money on something. If it does work well, then negate all the billions of dollars that they've already spent, because this is the new thing. So I think it's a good thing. I'm glad that they're doing it, and maybe others will join them. I don't know.
Well, indeed. I mean, I think your theory is probably right, because also there's a lead time before these kind of investments pay back or pay off, and obviously there is also the necessity for politics to create the right political environment for these technologies to even work.
Yeah.
Because electric vehicles don't work without charging points, and hydrogen enabled vehicles don't work without hydrogen charging points. And I think you said it before, there are 11 functional charging points in the UK. And currently I think you can drive on one hydrogen fuel charge like 300 miles. So you better hope that at the end of those 300 miles there's another charging point.
Yeah, absolutely.
But anyway, that's not that's just short-sighted by me to say that's not an obstacle to the development of this, but obviously before this becomes a usable consumer product, we will need the infrastructure to support it. And currently that's not there because the investments have not been made. And so there's a longer lead time for industry, a longer payback period before they see a return on their investments.
Fair enough. Well, anyway, I think we might as well end on that note. I just wrote down. Obviously, you were talking about carrot and a stick earlier on, so I thought we'd maybe end on a couple of jokes on that. So, what's brown and sticky?
These are not going to be good jokes.
A stick.
I don't know.
A stick. What's brown and sticky? A stick.
Like I said, it's not a good joke.
And then the final one is, what's orange and sounds like a parrot?
Yes.
A carrot.
There we go. Did you not used to do stand-up or something? Why did you never pursue that as a career? I've always wanted to ask you this. I think I know the answer now.
Yeah, well, there's the old line, isn't there, that everyone laughed at me when I said I wanted to be a comedian, and no one's laughing now. So
that's actually that's funny.
That's actually good. Yeah, it's not mine.
Even I get that.
Yeah, no, it's good. Anyway, maybe that's a good place to end this week's chat. So thank you very much, as always, Ralph, for some very interesting insight. And thank you very much for viewers, listeners, however you're consuming this. And see you again soon. Many thanks.
Thanks.
Bye.
Thanks, guys.
Bye.
Bye.